Your stock market returns are quietly underperforming, even when you follow the advice exactly. You buy the recommended stocks, you diversify, you stay informed. Yet over time, your results feel inconsistent, unpredictable, slightly behind where they should be. The gap is small at first, easy to ignore, but it compounds. And beneath that gap is something most people never question. The advice itself is not designed for the outcome you expect. Most people believe stock market advice is reliable because it appears rational. It is backed by data, delivered by professionals, repeated across books, media, and platforms. It feels responsible to follow it, disciplined, safe. You are told to think long-term, to trust the system, to stay consistent. And for a while, everything seems aligned. The logic is clear, the strategy is simple, the expectation is stability. But the results rarely match the clarity of the advice. And that misalignment is where the tension begins. What people notice first is confusion. Two experts offering opposite views. One says buy, another says sell. One predicts growth, another warns of collapse. Both sound convincing, both use data, and both cannot be right at the same time. This contradiction is often dismissed as normal market uncertainty, but it reveals something deeper. Advice is not a reflection of certainty. It is a reflection of perspective, and perspective is shaped by position within the system. Beneath that visible contradiction is a mechanism most never see. Stock market advice is not created in isolation. It is produced within an ecosystem of incentives. Analysts work for institutions. Media platforms compete for attention. Influencers build audiences. Each layer has its own objective: visibility, engagement, retention, profit. The advice that spreads is not necessarily the most accurate. It is the most aligned with these incentives. And over time, that alignment shapes what people hear. This creates a subtle distortion. Advice becomes optimized for attention rather than outcome. Bold predictions travel further than measured uncertainty. Simple narratives spread faster than complex realities. Urgency captures more focus than patience. So the information that reaches most people is not neutral. It is filtered, refined, amplified. Not to deceive, but to perform within the system it exists in. And that performance changes its function. People adapt to this without realizing it. They consume more content. They follow more voices. They seek clarity by adding more inputs. But each input carries its own bias, its own incentive, its own limitation. Instead of reducing uncertainty, the accumulation increases it. And in response, behavior becomes reactive. Decisions shift from long-term positioning to short-term interpretation. Not because people intend it, but because the environment encourages it. Over time, this creates a behavioral trap. The more advice you follow, the more you feel the need to adjust, to respond, to optimize. Each new piece of information suggests a change, a better opportunity, a hidden risk, and acting on that information feels responsible. But constant adjustment introduces friction, costs, missed compounding, emotional fatigue. The system does not need to force mistakes. It creates conditions where they emerge naturally. This is where the structural lock-in begins. Your portfolio becomes a reflection of accumulated decisions influenced by external signals. Your confidence becomes tied to validation from those signals. Stepping away feels risky. Ignoring advice feels irresponsible, so you remain engaged, continuously processing, continuously adjusting. Even when the adjustments do not improve outcomes, the system sustains itself through participation. At the same time, large institutions operate differently. They generate the data. They influence the narratives. They have access to information, timing, and scale that individual investors do not. Their strategies are not built on reacting to public advice. They are built on positioning ahead of it. This does not make them infallible, but it creates an asymmetry. The advice reaching individuals often reflects conditions that institutions have already acted on. This gap is rarely visible in real time. It becomes clear only in hindsight. a stock recommended after it has already risen, a risk highlighted after it has already materialized. The timing feels slightly delayed, not enough to be obvious, but enough to affect results. And because the delay is subtle, it is often attributed to market randomness rather than structural design. The system does not require individuals to fail. It only requires them to operate within its timing, to receive information after it has been processed, to act within a framework shaped by external incentives. Within that framework, outcomes will vary. Some will succeed, many will not. But the system remains intact because the variation appears natural, like chance, like skill, like luck. This is where identity begins to intersect with behavior. People who believe they are being diligent by staying informed may actually be increasing their exposure to noise. Those who seek certainty through expert opinion may be reinforcing dependence on external validation. Those who avoid risk by following consensus may be aligning with positions that are already crowded. These behaviors are logical within the context they are presented, but the context itself is structured. The realization is gradual. It does not arrive as a single moment. It builds through experience, through patterns that repeat, through outcomes that feel slightly misaligned with effort. Each instance is small, easy to rationalize, but together they form a recognition that following advice does not guarantee alignment with opportunity. That information is not the same as advantage. There is a cost to this realization. Time spent adjusting instead of compounding. Capital moved in response to signals rather than strategy. Opportunities missed because attention was elsewhere. These costs are not dramatic. They accumulate quietly, and because they are quiet, they are rarely measured directly. But they shape the trajectory of wealth over years. The longer this pattern continues, the more embedded it becomes. Habits form, expectations adjust. The process of seeking and reacting to advice becomes normalized. Breaking away from it feels uncertain, not because the alternative is unknown, but because the existing pattern feels familiar. And familiarity creates comfort, even when outcomes are inconsistent. What makes this difficult to confront is that stock market advice is not entirely wrong. It contains truth. It reflects real data. It provides frameworks that can be useful. But its function within the system is not solely to guide individual outcomes. It also sustains engagement, participation, attention. These functions coexist, and they influence how advice is created and consumed. This creates a layered reality. On the surface, advice appears to serve the individual. Beneath that, it operates within a network of incentives that shape its form and distribution. Both layers are real, but they are not always aligned. And that misalignment is where the gap emerges. As more people participate in the market, this dynamic intensifies. More voices, more content, more signals. The volume increases. The clarity does not. And within that volume, the ability to distinguish between information and influence becomes more complex. Not because individuals lack intelligence, but because the system itself is designed to generate constant input. What this reveals is not a flaw in the market itself, but a characteristic of how information flows within it. The market operates on price, on transactions, on ownership. Advice operates on interpretation, on narrative, on timing. These are different layers, and confusing one for the other creates distortion. The consequence is not immediate failure. It is gradual divergence between effort and outcome, between expectation and result. And because the divergence is gradual, it rarely triggers a clear response. It is absorbed, adjusted to, lived with, until it becomes normal. At some point, the pattern becomes difficult to ignore, not because of a single loss or mistake, but because of accumulated experience. The sense that something is slightly off, that the process does not fully align with the outcome, that following the path does not always lead where it suggests. And once that recognition forms, it does not easily disappear, because it is not based on a single piece of advice, but on the structure that produces it, a structure that continues to operate, continues to generate signals, continues to shape behavior, the question that follows is not about which advice is correct. It is about what role advice actually plays within the system, whether it guides decisions or whether it guides participation itself. And if participation is the constant, then the impact of advice may extend beyond individual outcomes into the behavior that sustains the entire system. That realization does not resolve anything. It does not provide clarity or direction. It simply shifts perspective. From viewing advice as guidance to seeing it as part of a larger mechanism, one that influences not just what people do, but how they think about what they are doing. And once that perspective shifts, the experience of the market begins to change. Not in its movements, but in how those movements are interpreted, in how signals are received, in how decisions feel. Because the system has not changed, the advice has not stopped, the signals continue, but the understanding of what they represent is no longer the same. And that difference, once seen, does not close. It expands quietly, shaping every decision that follows, long after the advice itself has faded. For more long-form thinking about investing, incentives, and financial systems, subscribe to Finance Simplified.